Imagine this, the market's going parabolic, your portfolio is up 5x, 10x, or maybe even more, but in a matter of days, everything could come crashing down. And it's game time because the Fed just announced rate cuts for September, the elections in the US are coming up, and the general sentiment is getting bullish again. So now is the perfect time for you to revisit your portfolio and profit-taking strategy, and you better make sure you and your positions are prepared for the next months to come. So stick with me and I'll show you exactly how to lock in those gains before it's too late. It's not a secret that crypto markets are notorious for their wild swings. While it's thrilling to see your investment skyrocket, it's just as painful to watch those gains vanish overnight. The truth is, even in the strongest bull markets, corrections are inevitable. And if you're not prepared, you could end up back at square one or even worse. That's why today we're diving deep into profit-taking strategies that not only protect your gains, but also set you up for long-term success. So let's kick things off with the 50-50 method, a straightforward strategy that's especially perfect for beginners. Here's the idea. When your investment doubles, sell half. That's about it. By doing this, you've secured your initial investment and now you're essentially playing with house money. And if the market continues to go up, great, you're still in the game. If it drops, you've protected your initial investment. But what if you're a bit more advanced and willing to take on more risk? Here's an advanced twist for you. Instead of selling half at 100% gain, consider selling smaller portions as the asset appreciates. Say 25% at 100%, another 25% at 200%, and so on. This way, you're still securing profits, but allowing more of your position to ride the wave higher. Let's say you bought $1,000 worth of Ethereum at a $2,500 price point. When it hits $5,000, you sell $500 worth. In the advanced version, you might sell 250 at 5,000, 250 at 7,500, and so on. This method helps you lock in profits while still maximizing your upside potential. Next up is staggered selling, a strategy that reduces risk over time while you still benefit from market growth. The conservative approach is to set predefined milestones. For instance, selling 20% when your asset is up 50%, another 20% at 100%, and so on. This way you're gradually locking in profits while staying in the game. But here's where it gets really interesting. In a parabolic bull market, prices can easily go 2x, 5x, 10x, or even higher. So if you're willing to take on more risk, you might actually consider larger intervals or setting more ambitious milestones for yourself. For example, instead of selling at 50% gains, you might wait until a 200% gain and then sell 30% and another 30% at maybe 500%. It's riskier, but the rewards can be much higher. But how do we define these kind of milestones? Well, it really depends on your risk tolerance and the market sentiment. You could use technical indicators like resistance levels or set psychological price points like round numbers, $10,000 or $50,000, etc. On top of that, you can compare your projects to other similar projects with similar potential. For example, you can take your investments and set different price targets based on your research. Whenever you reach a price target, you can look at the next target and evaluate how realistic it is to reach that next target based on the current state of the market. If you think there's a 70% chance to get to the next price level, then sell 30% of your bag. If it's only 50%, then just sell 50%. In the end, the key is to have a plan and stick to it, and the plan needs to be in place when your emotions are not in the way. Next up, dollar cost averaging, or DCA, is one of the most reliable strategies out there, especially if you're not trying to time the market. The basic idea is to invest a fixed amount of money at regular intervals, regardless of the asset's price. This reduces the impact of volatility and helps you avoid the stress of trying to buy the dip. But did you also know that you can DCA out of a position? This means selling off small portions of your holdings at regular intervals, similar to how you bought in. This method is perfect if you want to avoid the pressure of deciding when to cash out completely. It's slow and steady, but it works. Let's say you've been DCAing into Bitcoin, buying $100 worth every week. When the market starts heating up, you can flip the strategy and start selling $100 worth every week. This way you're gradually taking profits without worrying about hitting the perfect top. Now, here's where things get really powerful: combining strategies. You don't have to stick to just one method. For instance, you could start by using DCA to build your position, then switch to staggered selling as the market rises, or maybe you use the 50-50 method on one asset while employing an advanced staggered approach to another. Imagine you've got a diversified portfolio with Bitcoin, Ethereum, and a few altcoins. You might then consider the 50-50 method for Bitcoin, staggered selling for Ethereum, and DCA out of your altcoins. This way you're covering all bases and reducing the overall risk. It's like having a Swiss knife for your portfolio, versatile, adaptable, and ready for anything. One of the toughest decisions is knowing when to cash out completely. This could be when an asset reached what you believe to be its peak, or when the market is showing signs of a potential correction. It could also be when you spot a new opportunity that you believe has more potential. Here's a tip. Consider setting a final price target based on market cycles, technical analysis, or maybe even Bitcoin's price. Once that target is hit, cash out and consider rotating those gains into something new, whether it's another crypto, a different asset class, or even just holding cash. Remember, the goal is to preserve your wealth, not just chase the next big thing. And also keep this in mind, when you cash out with profits, you don't have to worry about what happens to that position again. Be happy, don't be greedy. So how do you keep track of all of this without losing your mind? There are some awesome tools out there that can make your life a lot easier. For example, portfolio trackers like CoinStats or Delta can help you monitor your gains in real time and set up alerts for your target sell prices. These tools are great for keeping a pulse on your portfolio without the need to be glued to the screen all day. Both actually have quite advanced functionalities and offer also a free plan with limited features. So I'll add the link to both tools down below and you can check it out for yourself. But if you're looking for something simpler or maybe cheaper, you can check out a tool called Crypto Alerting as well. This is a tool that I use myself, and this service allows you to set up custom alerts for price movements so you never miss a critical sell point again. They offer a free plan where you can set up to 3 alerts, which is great for those just getting started. But here's the thing. If you're not going to be in front of your screen 24/7 during the bull market, or if you've got a lot of different positions, I highly recommend upgrading to their paid plan, which is just $3.99 a month. The paid plan gives you up to 20 or more alerts depending on your needs, and trust me, it's absolutely worth it. The money you invest in the plan will easily pay for itself by enabling you to react quickly and lock in your profits when it matters most. Just set it and forget it. Then you go outside, get some fresh air, touch grass, or at least you pretend to do so. So I'll add the link in the description down below, so check that out as well. I can highly recommend this tool. But remember, these strategies aren't foolproof and the market is pretty much unpredictable. The goal here is to create a plan that helps you lock in profits and reduce your exposure to risk. It's not about timing the market perfectly, it's about making sure you come out ahead no matter what happens next. Now, which strategy you pick really depends on your own risk tolerance and how much experience you have. If you've never experienced a bull market before, you might want to go more conservative. If you know the crypto space and your projects and their potential very well, then you might be able to take a bit more risk. And of course, always remember, never invest more than you can afford to lose. Crypto can be a wild ride, but with the right strategies in place, you can protect yourself from the worst of the volatility. That's it, folks. If you found this video helpful, please smash that like button, subscribe for more tips and strategies, and hit that notification bell down below so you don't miss out on any of our future videos. Thanks for watching, and I'll see you next time.